Hello, it's Gill Fielding here, and this is what's caught my eye in the media this week. Well, first of all, there's a bit of a hurrah, because finally we've got rid of those awful letters POA, and that's what estate agents put at the bottom of houses where they don't want to tell you the asking price, the selling price, whatever. So they put POA, which means price on application. And I've always felt that was a bit mean. It's sort of like telling people they can't be a member of the club and they're not good enough. And if they have to ask the price and they can't possibly afford it. It's always been a sort of a trick and a ploy, and I've never liked it at all. And of course it isn't transparent. Can you imagine going into a supermarket and wanting to buy a melon, and on the melon it's stamped POA, and you have to take it to the checkout and the till and say, how much is it? Oh, it's £2. Oh, I won't have it then. It's a ridiculous notion not to tell people the price of a good that you're actually selling. So I'm glad to say that the National Trading Standards have said that can no longer happen from the end of this month. So hurrah on that. Well, I wanted to talk a little bit about different trends emerging in the property market. And I've always said, don't touch the centre of London with a barge pole, because that's where the overseas international investors go. They buy in the centre of London and they distort the prices, and the prices don't react in the same way that we understand that happens around the rest of the country. But since we've had world crises of one thing or another, the amount of international money coming into the centre of London, particularly buying property, has diminished hugely. And it's fallen from about 55% of all purchases in the centre of London to 27%. And that's even lower if you extend that out to Greater London, where it's fallen to 23%. So that's an interesting trend emerging. And I'm not saying let's all dive back into the centre of London, because obviously the prices are still very, very high and not really the sort of standard property that a property investor would be looking at. But keep your eye on it. You never know what's going to happen there. And I suspect the international money will start coming back sooner or later. But it's an interesting trend to see how they've all stopped buying in London. Now, I've just read that apparently £2 billion have been put into premium bonds since the start of this year. That's a ridiculous amount of money, particularly into a ridiculous scheme. I've never liked premium bonds. My parents had them, and I'm sure your parents have had them, and you may even have them. But the way premium bonds work is that they collect all the money that people donate, save, invest, call it what you will. And then rather than paying them interest on that money, they put an equivalent amount into a pot, and they randomly select who's going to get interest. And that's in terms of like a win on the premium bonds. The vast majority of wins are about 25 quid, sometimes 100 quid. And apparently something like 98% of people who've been invested since 2007 haven't won anything. And only about 100 have won over £5,000. So in any amount, any significant amount. So I think premium bonds are a daft idea. I think they're for people who are not very good at maths, because the numbers just don't work. You could put that money into a savings account and get a better return. Although apparently the average return you do get from premium bonds is about 1%. So not far off the same as if you put the money into savings. But of course, the reason they're so exciting and there's an allure to them is that there's always the chance of that big win. And so it kind of combines savings with an excitement. And of course, you do always get your savings back, even, you can cash in the bonds. You don't lose it like you would if it was a lottery ticket, for example. So I can see why it is appealing to some people, but doesn't float my boat. The returns are very poor. The chances of winning are so absolutely slim. I'd rather put my chances into something that's got 100% certainty and something that I can calculate with accuracy, and that isn't premium bonds. Now, I just wanted to add another couple of comments to something I said last week about the rising interest rates. Now, the base rate has risen to 1% now, as we all know. The long-term government aim is for it always to be between 1% and 2%. And that's ridiculously low. In my lifetime, I think in the 70s, base rate was up to 16%. And the average mortgage rate in the mid-70s was between 9% and 10%. And if you compare that to mortgage rates today, I think the average fix is about 1.7, the average variable is about 1.8, base rates are 1. Okay, we have inflation at 7% and rising. But fundamentally, the cost of borrowing is still incredibly low. And it's such a shame that people don't put the current situation into perspective and get a better sense of circumstances. And in any case, interest rates will undoubtedly rise again this year, but they won't be anywhere near the double digits that we saw, certainly when I was first investing. You know, so just get a bit real and stop panicking and get a bit of perspective there. And all of that makes our current circumstances, our current inflation, our current base rate and our current mortgage rates all seem rather positive. Well, keep safe and I'll see you again next week.